US stocks and bond yields are down sharply this morning after Donald Trump accepted the US economy might slow down. Oil prices keep falling on demand and supply fears. The euro surges on hopes for bigger European defence and infrastructure spending. That's coming up in our 5 Things in 5 Minutes on Tuesday, March the 11th. And then in today's bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes looks at the surprising performance of US shale oil producers and what they might do now oil prices are well down below $70 a barrel.
For them to actually grow their output even further, I think they'd need to see much higher prices as well.
But first, in 5 and 5 with ANZ, US stocks are down sharply and US bond yields are retesting their 2025 lows on renewed fears about a US recession caused by trade policy zigzagging and inflation fears. Those fears deepened after Donald Trump acknowledged in an interview with Fox News' Maria Bartiromo overnight that a slowdown was possible in a, quote, period of transition.
Are you expecting a recession this year?
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. But I think it should be great for us.
As of 4 a.m. Sydney, Melbourne time, the Nasdaq was down 4%. The S&P 500 was down 2.6%, and the US 10-year Treasury yield was down 10 basis points to 4.20%. ANZ economist Bunzi Madhavani says from London this morning that markets fear a sharp US economic slowdown.
Markets are extremely worried following the recent comments from US administration, which signal that the policymakers are willing to bear some short-term pain. President Trump spoke about the US economy likely to face a period of transition. And earlier, Treasury Secretary Bessent spoke about a detox period for the economy. What this is adding to concerns of economic slowdown, and that's causing Treasury yields to fall and equities to decline. The fact is that the administration is preparing the markets to bear some short-term pain. But the broader fear is what happens if this short-term pain snowballs into something that's longer lasting.
As of 4 a.m. Sydney, Melbourne time, the US dollar index was flat, the Aussie dollar was flat at 63.03 US cents, and the Kiwi was up 0.3% at 57.24 US cents. West Texas oil futures were down 1.2% at $66.21 a barrel, more on that shortly, and gold was down 0.1% at $2,910 an ounce. Number 2. One winner in recent days on fears of a US slowdown at the same time as a European defence and infrastructure spending splurge is the euro versus the US dollar. It was up another 0.1% versus the US dollar overnight, with 1 euro buying 1.0838 US dollars, up from 1.04 10 days ago, and a long way from parity. Here's Bunzi.
Until last week, the euro could not catch relief from growth headwinds, and ECB's policy easing was the only game in town. But the prospect of fiscal shift promises to alter the region's longer-run potential. We're looking at a boost in defense spending worth 800 billion euros, coupled with Germany's fiscal policy shift. If and as and when they are implemented, these can have large growth multipliers, potential to improve productivity, and structurally support a growth turnaround. The euro is essentially reflecting this optimistic turn of events and has driven the rally.
Number 3. The other big market mover in recent days has been the oil price, where a surprising new burst of supply is dragging on prices, which have fallen from $78 a barrel at the start of the year to $66 overnight. And Donald Trump is not far from the action here either, both with Russian oil supplies and Saudi oil supplies. As ANZ Senior Commodities Strategist Daniel Hynes explains.
The prospect of a peace deal driven by Donald Trump is raising concern that maybe those barrels that have been going to countries like China and India may be flowing a little bit easier to the West if some sort of sanction relief is part of that peace deal. But certainly other supply side issues have been weighing on the price as well, and that namely being the recent announcement by OPEC to go ahead with its sand production hikes.
Number 4. Daniel says markets had expected Saudi Arabia to delay production hikes for a 4th time.
Trump's broader tariff war does put a question mark over global economic growth. The group decided to go ahead with those hikes, which will mean from April we'll see approximately 138,000 barrels per day of oil added to the market per month over the course of the next 18 months. So suddenly, after 12 months of these ongoing supply-side disruptions, we're now potentially facing a wave of new supply hitting the market. And that's really weighed on oil prices over the past few weeks.
Number 5. ANZ Research expects Australia's infrastructure pipeline to grow by almost $13 billion to a peak of $80.3 billion in the next fiscal year. In fact, over the next 5 years, it's expected to grow to $72 billion per year on average. That's up almost 50% from the previous 5-year period. ANZ senior economist Adelaide Timbrell says public sector investment remains important, but there is a shift to private sector spending as well, as is happening in the wider economy.
There's much more on the private side of things that is growing in the pipeline over the coming years. Electricity is a really, really important part of this, but at this stage, it's really a rotation out of public sector projects into the private sector.
Adelaide Timbrell there. Now, in our bonus deep dive interview, I spoke with ANZ's senior commodities strategist Daniel Hynes about the surprising performance of US shale oil producers and what they might do now oil prices are down sharply. Now, in a recent note, you've come up with a fascinating chart looking at US oil production over the past decade, and it surprised me, but US oil production is now 50% more than oil production in Saudi Arabia, thanks to a lot of oil output from the various shale reserves. What do you think might happen here as this price drops? Will the shale producers dial back, or have they got some momentum going? Because they've really recovered to their peaks.
Yeah, they're certainly performing extremely well. In fact, we've seen a pretty steady decline in drilling activity over the past 12 months or so, but they've continued to raise output. So efficiency gains, stronger volumes per well are resulting in those gains. But I think looking ahead, a lot of them would be relatively cautious about any further growth, particularly new wells, which at current levels, a lot of them may not make economic sense. So Trump's desire to really dominate the energy space and drill, baby, drill may fall short, because I think the economic realities for a lot of those producers will mean that they'll continue to look at margins, and potentially that could see some of their higher cost operations actually just put on the back burner if prices do continue to fall. So I wouldn't expect to see a huge level of growth from the US oil industry this year. I think we're expecting it to stay essentially flat over the course of the year, and certainly the prospect, I suppose, of potential fall is there if prices do weaken a little further than where they are at the moment.
Because in the past, the shale producers have been very disciplined about their investment spending, is one way to describe it. You do wonder if under Trump they'd be more willing to go for it.
Well, I think they've certainly been happy with the potential reduction in red tape and government sort of regulations. That's certainly been welcomed. But I suspect they'll take that as a bit of a cost reduction effort. And in fact, it'll improve their margins and allow them to produce bigger returns for their investors, rather than that old mentality of growth at all costs. So, yeah, they'll certainly take that. But I think for them to actually grow their output even further, I think they'd need to see much higher prices as well.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, March the 11th. Catch you tomorrow with the latest on Australian business confidence figures out today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.